So the Bank of England has put its rate up 0.75%. That's the highest rise in many, many years, over 30 years. Now, what on earth does that mean for your mortgage? Well, let's find out together. Hey everyone, welcome back to the channel. My name's Adam. I'm an expert mortgage broker, and today we are talking about the Bank of England and mortgages, fixed rates, tracker mortgages, all of that, all that goes with the Bank of England base rate, what it all means for you. So if you find today's video useful, give us a thumbs up, subscribe to the channel so you don't miss the next one too. So let's start then with the people that are affected the most by the Bank of England base rate going up, and that is people that are on a tracker. So if you're on a tracker mortgage, you're probably on a Bank of England base rate tracker mortgage. Now, we use those quite often for people because they tend to be a little bit more flexible. You tend not to have any penalties and things with some lenders. So it's normally a short-term solution. You know, if you want to pay a mortgage off or move or something, it's a good sort of short-term solution. But if you're on a tracker, you're going to follow or track the Bank of England base rate. So that means if the Bank of England base rate goes up or down, your mortgage does the same thing. Now, it just so happens that the Bank of England has just put its rate up. So it's worth saying, actually, where are we now? Sort of early November. The rate has just gone up to 3%. Depends when you're watching this, obviously, as to what it is right now for you, but here and now it's 3%, so it's just gone up 0.75%. So if you are on a tracker mortgage, your mortgage rate will do exactly the same thing. It will go up by 0.75%, which means your monthly payments will go up. It normally kicks in the month after, so from December, that's when your revised monthly payment will start. Now, less people are on a tracker than they are a fixed rate. So if you're on a fixed rate, then this is the bit for you. You need to listen up because we're going to explore what a fixed rate is and what it does and what it means and how it's linked to the Bank of England, because you might be surprised by the answer. Or if you're looking for a fixed rate mortgage, keep watching because you're going to be a little bit surprised at what the outcome of this is in a few minutes' time. So let's start with some facts then. So a fixed rate is kind of does what it says on the tin, really. So it's level, it's set, it's fixed for a set period of time. So you know that for the next 2, 3, 5, 10, however long years, 2, 3, 5, 10 years, that your mortgage, your rate will be exactly the same. It will not change. And if your rate doesn't change, then your payments don't change either. So it's great for budgeting. You know exactly what is going to happen, you know exactly what your payments are going to be for that given period of time. Now, after that, then we refix or we do something else. Let's not worry about that right this second. So your fixed rate is not going to change. Now, if you're looking for a new fixed rate, or yours is coming to an end and you're going to need a new one, this is the bit for you. So I was invited onto a local radio station to talk about this the other day, by the time you watch this, a week or so ago. And they wanted to know how the Bank of England base rate going up was going to affect people's mortgages. So I told them. My interview didn't last very long because actually it wasn't scaremongering, it wasn't doom and gloom, and I kind of got accused a little bit of playing it down. Well, actually now everyone can see that we were dead right. We weren't playing it down at all, and that is because the Bank of England has very little effect on fixed rate mortgages. Let me tell you why. So the banks, building societies and things, banks need to get the money to lend to you on a mortgage. So they tend, obviously they have some savings and things from people depositing money, but they tend to borrow money from other places, let's just say from markets, from other places, don't worry about where from, but they borrow the money to then give to you. And they borrow it at a set rate, and then they lend it to you at a higher rate, and then there's their profit, so their margin on that. So they borrow the money at 2% and they lend it to you at 3%, and then there's your profit. That's very obviously rough, rudimental figure. But those rates that the lenders use to borrow money, they're called swap rates. Now, swap rates are not linked to the Bank of England. Generally, you can see sort of a pattern, going up and down, but they are not linked to the Bank of England base rate. Swap rates are influenced by many factors, you know, the world, the economy, you know, different things that are happening in politics and things, you know, the pound going up and down, who's the prime minister, which countries are fighting with which countries in the world, you know, how much it costs, inflation, everything, the whole world economy affects these swap rates. So it's a bit turbulent at the moment, isn't it? You know, recovering from COVID, war in Ukraine, new prime ministers and things. So we saw that, so when Liz Truss got elected, well, not elected, but, you know, whatever, when Liz Truss came in as prime minister, and they did that mini budget, they called it the fateful mini budget, that sent the economy and everything into complete chaos. No one knew what to do. You know, everything was chaos. Swap rates went through the roof. That's when a lot of lenders withdrew all their rates from the market. You may remember all the headlines, you know, mortgage lenders withdrawing rates. It only lasted a few days. It's because they didn't know how much to price them. They didn't know how much they were going to be. They didn't know how much it was going to cost them to get the money to lend to you. So that sent the whole economy into, you know, chaos. But since then, so we had a new chancellor, didn't we, a few weeks later, that's started to calm things down, and then since Rishi has come in, again, that's calmed things down, and we've seen these swap rates gradually coming down and down at the time of filming. Very important we say that. Who knows what it'll be in a week's time. But at the time of filming, we've seen these swap rates coming down and down. And that is good for your fixed rate. So we've also seen lenders reducing their fixed rates. Only today we've had 2 or 3 lenders say they're going to reduce their rates in the next few days. So you've got the Bank of England going up on one hand, and everyone panicking that mortgages were going to be, you know, 1,000,000%. But actually these swap rates, the real things that influence the fixed rates, they've been gradually coming down. So that's why we're seeing fixed rates slowly starting to come back down again and just get a little bit more normal. They're never going to be back down to, well, I'd say never, you know, for the foreseeable future, we're never going to be back down to 1%, 2%, but, you know, 3 or 4% is probably where we'll end up. But they're starting to get a little bit more normal. So it's these swap rates that dictate what your fixed rate is. Just because the Bank of England went up does not mean that your new fixed rate is going to be 0.75% higher than it would have been last week. Actually, it's probably going to be a fraction lower. And hopefully we'll continue to see that trend going forward. But it is a worrying time for everyone. So if you would like to know what fixed rates are and what fixed options are there for you versus what tracker options as well. I did a video the other day about fixed versus tracker, because trackers definitely have their place. But if you want to know what's best for you and what your options are, you can feel free to pop onto our website, book a free call with us on there, and we'll go through your situation and what you're after and what rates are going to be. There's no obligation. The most important message here is that you use a broker. It doesn't have to be us, it could be any mortgage broker. There's loads and loads of good ones out there, but use a mortgage broker because we've got up-to-date information, we've got the latest rates always, and we always know when rates are coming down. So actually we've had a few customers lately where we did a mortgage application for them a few months ago when the rates were highest, and now they're starting to come back down a little bit. So we're monitoring when's the best time to change the application we did and go for the newer rate. And we can do that with the same lender. We just choose a new product. So there's no new application or anything. Just choose the new rate to make sure that they're always getting the best rate. Now, you won't get that if you do that, if you do the mortgage yourself. So use a mortgage broker. That is the key message. If you want to use us, that is great. If you want to talk to us, pop onto our website, book a call. We'll hopefully speak to you very soon. If not, as always, I'll see you on the next video. Take care.